Right. Hello and welcome to Talking Point. I'm your host, Neeraj Shah, and the case for a chat today with our guest is simply around what the near term and the medium term might hold in store for multiple things. So firstly, will FIIs or can FIIs invest in India amidst the higher multiples? Is past history anything to go by? I think Vinod Karki dwells a lot on learnings from the past, so it'll be lovely to talk to him on that. Whether there's room for credit to grow and aid Capex. I think we'll pose a question to him around that. And whether low deposits can dampen the BFSI outlook, or do valuations provide comfort there? He's Senior VP Equity Research at ICICI Securities, joins us right now on the show. Vinod, good having you. Thanks for joining in. I hope all is well.
All well, Neeraj. How are you?
Very, very well. Thank you, Vinod. And I want to start off, Vinod, by asking you whether you believe the nature of the money getting invested into India can change in the second half now that major events are out of the way. Let's assume the budget is a bit of a non-event from a capital market investor perspective on taxation front at the very least. Do you think at some point of time FIs make a comeback into India despite the higher valuations, or is that a difficult call to make?
Well, talking about events, I mean, you can call it a myth, basically. Over the last, since COVID, there were like 3, 4 events which were kind of resulted in high uncertainty for investors. And they were the best times to buy within this bull market, if you may call it so far. So, to answer your question, if there is an event where you find uncertainty, in fact, our reading has been that all through over the last several years, whenever there is an event risk related uncertainty and markets take a little bit of a knock, that has been the best time to invest. Not when everything is hunky-dory and volatility is extremely low and everyone is extremely confident about the future. That has not been the best time to buy, at least in the recent history. So, so we had, several. So if budget or something else comes up, leads to some kind of uncertainty and some of this euphoria. I mean, this optimism that we have been seeing post-election is allowed. I think that would be a good time to buy overall.
Okay. Vinod, are you constructive on markets currently?
Well, the way I look at overall market is quite simple, in fact. So I'll start getting worried on the overall market when, so if you look at the multiple and the growth, so there are two aspects to this. If you just go back to when the global financial crisis at the start of 2008 calendar year was, when we're looking at the forward multiples, it used to be, in fact, similar, 21 times or something like that. So point in time multiple tells you nothing, basically. So, and in September of 21, we were at 23 times forward. So what can you say, basically? So the point is, and which legendary investors like Ben Graham and some other guys who have built some frameworks like the Schiller model, what they say is that you better look at where you are in the cycle overall in terms of corporate profitability, leveraging, and other things. So currently what I see is that while we are at somewhere, the higher end of the multiple, around 20 times, 21 times, in terms of the profit cycle, we are somewhere in the mid cycle, around 5% of GDP. Max, we have maxed out at around 7%. And if I look at what leads to maxing out of profit cycle is very simple. You have overheated economy, you have high leverage in the balance sheets and high operating leverage, and risk taking is very high. A lot of acquisitions and a lot of what I should say, a lot of capex outlook being very high and all that. Investment cycle being very at the top of the cycle. So I think those things, if you look at the profit cycle, we are mid cycle. In terms of corporate releveraging, I think we have hit a bottom, and maybe some pickup we might hope for some pickup. And overall NPA cycle in the system is still bottoming out. So overall, I think we are at mid-cycle profit and almost at the just below the peak multiple. So that's how we should look at it. I'll start getting worried on the market when we are at peak profit cycle, driven by high leverage, high operating leverage, and peak profitability.
Okay, high operating leverage, peak profitability. As of now, those situations don't exist, I presume, is what Vinod Karki is saying. Vinod, what takes this market higher? Is it the mover of the last few days, which is BFSI, because it was dead and buried, or rather not moving, was in hibernation of sorts for such a long time, has started to make a move and may not be as much of a value as it was maybe a couple of months ago, but still not egregiously expensive?
Yeah, that's a very good question, Neeraj. And if you look at the pre-COVID period till now, the only sectors where valuation actually has contracted to what they were pre-COVID is the whole financial pack within the Nifty, if you take it as an example, and energy stocks. They remain quite cheap overall. Uh, but the other angle to this, the growth angle, is while the market has completely embraced the idea that there is a big capex cycle coming, which is shown in industrials, the capital goods companies, and others going, the valuations flaring up. Uh, the 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 clarity is not there in terms of how much releveraging will happen, but from a framework perspective, we haven't seen any economy rise in terms of investment rate, manufacturing, construction, and all really picking up without a releveraging effect. So I think it is imminent, the releveraging effect. I think market is kind of sniffing it out in the current context, and you're seeing some kind of outperformance. But if you are bet on the industrials, saying that there is going to be a big capex cycle, I don't see the financials which will fund this capex or channelize savings into funding this capex, uh, remaining underperformers for too long.
Uh, Vinod, so what? Okay, the last 4 years, we've seen a resurgence in the valuations of the public sector banks, public sector financiers at large maybe, versus the private sector financiers. The last 5 days have been the first instance of how private ones are outperforming PSUs. My question to you rather is, then when people are talking of a convergence in valuations, private sector has started to outpace on the valuation front the public sector entities once again. From here on, for the next 24 months, if indeed Capex has to pick up, which will probably go to both PSUs as well as privates, would you bet on PSUs continuing their outperformance, or would you believe private sector players will now dominate?
Well, the corporate capex has predominantly been the area for public sector banks where they are focused. Uh, Private banks obviously participate wherever they find opportunity. But as an overall theme, if I'm betting on a corporate releveraging cycle, uh, I would bet that corporate banks, no matter if they are what you should say, I mean, the banks which can focus and which have exhibited in the previous cycle that they have the capability to lend to corporates. I think the distinction will move from PSU to private to corporate and retail. Basically. So any bank uh, which can lend to corporates in a way that it doesn't result in high NPAs. So I think those will show higher demand in my view. Because on the retail side, we have seen some stress, and RBI also kind of flagging it off. And a lot of players have entered retail, so it's getting a crowded place. While if you see the corporate side, uh, very few are participating, and the demand itself has not picked up significantly, which I think will pick up. So the distinction will be like we used to have earlier: corporate banks and retail banks, that distinction might start coming back again, rather than PSU versus private.
Okay. And any impediments, Vinod, to any kind of lending? Because the other aspect that happens is that the regulator of late, right? And it's good, by the way. I'm not saying that the regulator is doing a bad job, but I'm just saying that the regulators or regulatory action on financials, both lending and non-lending financials, has been fairly swift in the recent past. Does that impact multiples at all, you think?
No, so one is multiple, but the underlying cycle which I talked about, it actually extends the cycle because see, in any economy, when the releveraging happens, finally we'll have accidents at the top of the cycle. We cannot avoid it. That's the nature of economic cycles. What the regulator is doing by being a little ahead of the curve is trying to because they have learned from the previous cycles that where the hazards are, and they are safeguarding some of these issues. So, which means that you won't have early accidents in this economic upcycle, and this may be a little more prolonged. But eventually, every cycle goes through that boom and bust. This I think we are in a mid cycle. It will boom at some point, and there will be some issues at a later point.
Okay. Well, since you're talking about financials and NDTV Profit exclusive, banks have hit a pause on fresh project finance and seek clarity on RBI's draft rules. Vishwanath Nair joins in with more details on this. Vishy, this seems a very extreme step. Tell us, what are you learning?
Right, Neeraj. So yes, there is a decision amongst bankers, at least the majority of the bankers, that they want to not go out and do fresh project finance, specifically loans that are linked to special purpose vehicles in these projects. They don't want to do that unless, of course, the parent, which might be a well-rated company, takes those loans on its own balance sheet. What the lenders are saying is that if these RBI guidelines come into play in the form that they were proposed back in May, then these old projects might get pulled into the framework, and lenders will have to then later on add about 5% provisioning, upfront provisioning on these projects, which will be a pretty big hit on their balance sheet. So they've sought some clarity from the RBI. They want, firstly, public sector projects and private projects to be treated differently under these norms. They also want some more clarity on how exactly this 5% will come into play. Remember that the RBI is saying that this will be spread out over a few years, but they still want further clarity. Lenders also want the RBI to rethink that 5% number itself and probably come up with a slightly more realistic number, because currently the upfront provisioning is only 0.4%. So 5% is a significant jump on the provisioning from the current norms. So banks are saying that, listen, give us this clarity. That's when we will go out and start lending aggressively. This is also a time when project finance is actually taking off. Companies are going out and willing to set up greenfield projects. So if they are going to slow down, if the banks are going to slow down on that lending, then those projects get hit quite a bit, because banks are a major source of financing for these projects in that.
Okay. Vishy, clearly we do not have any timelines around this, right? I mean, as of now, it's a pause. They'll take things as things unfold, I presume.
Yeah, so June 15th was the date when the banks and the other stakeholders in the economy had to submit their responses to RBI's project financing draft. The government has only done that, this week. So there is a significant delay even on the government's part on giving feedback. Once this feedback is in, the RBI goes through all of this, and typically it takes about 30 to 60 days, anywhere between that, before the RBI comes out with a final set of guidelines. So we may not see something emerge clearly till end of July or maybe August.
Got it. Vishy, thanks for that. Vinod, quick thoughts on this one before we hit that break. I hope you heard. I believe you would have heard what Vishy's brought in.
Yeah. So this is an extension of what we were discussing.
Right.
So the regulators this time have, they want to ensure that we don't get into a situation that we got after 2012-13, when the NPAs started ballooning in the corporate side due to a lot of infra and other project finance and things like that. So this is just an extension. What one should note in this is that it actually is more of an accrual thing. So you are providing more. So if you have lent carefully, then obviously these provisions will be written back. So it's only about timing issues. rather than absolute losses, basically. So why should you fear if you have lent prudently, then these provisions won't be required. So that but the point is, if you provide early, then obviously you have you see the cost. I mean, the impact on P&L immediately. So cost would be an issue, but on the overall, it's more of a safeguarding measure, I would say, from the.
In a recent note, they've written that the listed corporate capex has swelled beyond the 9 trillion mark, and that there are new age sectors which are additional accelerators in the current cycles, and while the uptick is strong, it's still short of the lofty budget goals. So question is, Vinod, you would expect a bit of a lull in a period around the election season. Would you expect strong capex now? And what would lead it? Would it be private capex leading the capex charts now?
Yeah, so the reading is coming out that if you have been observing the GDP prints time and again over the last couple of years, the GDP has been driven by the gross fixed capital formation growing faster than private final consumption expenditure, which is reflected in the whole stock market, reflecting that same thing where the cyclical companies have been significantly outperforming the defensive staples companies. IT, which is another issue. But the thing is, the private capex is nudging up. So it's first of all, the reading is that it's bottomed out, it's rising. But if you compare it with the central government capex, in a scenario where private capex is doing really well, this is significantly higher. So just to put things into perspective, the central government capex was 9.4 trillion in 2024. Against that, the listed corporates did 9.1 as per our analysis. So this is almost no. I mean, the private guys are not significantly higher. At the peak of the cycle, we have seen this ratio being at almost 5 times. So I think this is and this was in a period where we were going into general elections 24. So I think post that, and in fact, yesterday itself, I saw one media report about a large industrial conglomerate significantly hiking their FY25 capex guidance to one of the largest, I would say. So I think it's showing up. We heard the SBI chairman talking
Vinod,
about.
Vinod,
Yeah.
Vinod, sorry, can I come in? So the larger ones are
Yes.
not a problem. Maybe the top 10 are doing the capex. Maybe newer sectors are doing it. But the widespread capex spend on the private side is not happening. So one, could that happen? And two, I'm just asking for a viewer who's listening to this right now and wanting to understand how to play it by the equity theme. What would you recommend?
So from a SME segment, if you look at their the commentaries coming in, I think this is the purple patch for SMEs. Simply because the growth in the economy is coming from the investment side, real estate development, infrastructure, manufacturing, construction across the board, and this new age. So the SME order book swells up in this environment. So I don't think there will be a dearth of capex requirement, a capex demand over there. So I think it will be a broad-based capex growth overall. In terms of playing this capex theme, the market is way ahead. I mean, we have been saying for the last couple of years that the capex is showing signs of improvement. But if you look at the industrials, capital goods, I mean, they have already made the move significantly before these numbers are coming in. That's what we have been signaling, that you cannot wait for the numbers to confirm and then say, then I'll take a position. By that time, markets are always forward looking. So in fact, if there is any weakness on the investment theory, these same companies will actually show signs of significant correction way before the numbers start showing. So I think so that's the thing. So the indirect way to play, I think, is the through the lending side, because that in fact has derated valuations over the last 5 years. Their valuations, whatever the large banks and financials, their valuations were pre-COVID. I think that the current valuations are in fact lower than what they were. So it's not completely reflecting this whole investment theory. So I think the best way to play is indirectly through the corporate deleveraging cycle and maybe some industrials, large industrials, which are not significantly overvalued. Just to name, for example, L&T, I don't think it is, uh, uh, I think it is, the P is around 30, in their 30s, I think. So I think that's a bellwether. I mean, it gets um, positively impacted from the overall Capex cycle. So, just to give an example, but the point is you have to dig through, but where the valuations are not significantly higher, those are spaces I think should be good to do. And I think the playing it through the lenders is better, I guess, right now from a risk-reward basis.
Got it. Okay, we are out of time completely on this leg of talking point. Vinod, afraid we'll have to leave it at that. Very interesting note. Would have loved to talk more, but time's up today. Thanks so much for taking the time out and being with us.
Thank you, Neeraj. Always a pleasure.
Likewise, and viewers, thanks for tuning in this edition of The Talking Point.